All right, folks, Steve Lentz here with the Inside Wire. It is June 27th, 2017. The presented materials for educational purposes only. It should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. I was clearing out a room one day. I have a little study upstairs, and we were going to paint it and all that stuff. So I'm going through the old books. I come across this old magazine, an old Stocks and Commodities magazine, and I'll pick it up and flip through it. And lo and behold, I came across an article, and it was from December 2013, a swing trading with 3 indicators. You know, I have several. If I were to stack all the old Stocks and Commodities, I've tried to save most all the issues in hard copy. Since 1998 when I started with OptionVue here, and I have accumulated just years and years and years worth of this magazine. I think it's awesome, and but it's, of course, all the articles are available online now, and it used to be available. Maybe they still do it. You could get a little CD and download years and years worth. But anyway. Flipping through, and I find this little article, and I thought, oh, this is kind of cool. And it reminded me of another one I'm going to show you in just a second. But so I thought, boy, this would be an interesting little thing to do with short-term credit spreads. So what I'm going to do is show you the rules behind this little swing trading system, and then I'm going to show you another system that's counter to it from another trading researcher. And then I'm going to just propose a little credit spread system, and I haven't back tested it, a lot. I'm just going to show you one trade and how it works, and then in the future, assuming that we get the time, we're going to do some back testing work and also maybe tweak some of the parameters. So I thought you'd find this interesting anyway, and educational, hopefully. So this was by Donald Pendergast, December 2013. And here is how it goes. You take a chart and you throw up 3 moving averages. A 50-day exponential moving average defines the trend, the long-term trend. And so here, when price is above the 50 EMA, that's when we trade from the long side. Okay, if it's below the 50 EMA, we trade from the bearish side. And then you have 2 other moving averages, a 5-day simple moving average of the highs, and then a 5-day simple moving average of the lows. All right, real simple. Now, on the bullish side, and this is where we're trading breakouts with the trend. And the context of Pendergast's article was clearly just trading the underlying. And it could be done in any asset, really any time frame, honestly. But the idea is that when you were above the 50-day exponential moving average, we go long when price exceeds the 5-day, and copy and paste is just bugging me. A 5-day SM, these are SMAs. Oh my word. I was put on tilt this morning when my Wi-Fi went out at my house, and I had to run to the office and put some of this together here. It's SMA. I'm so sorry. It's SMA. So these are simple moving averages. Okay, and so when price exceeds the previous day's SMA of highs, you go long on that breakout. For example, right here. Okay, and then you're in until price goes down and hits the 5 SMA of the low, the previous one from the previous day. Okay, and that's important. You want to look at the previous day's average, because that's frozen in time, and you can put in orders and all that stuff. You don't have to worry about what is today's moving average going to be. You use the previous day's moving average. So here in this particular case, we had a little bit of a gain. Now on the bearish side, it's just the opposite, although we're using simple moving averages. I don't know, just my brain was been on the ease. So when we're below below the 50, we trade the breakouts when price goes down and hits the previous day's 5-day moving average of the lows, and then we go short there. Here we would have been short until price came up and hit the 5-day simple moving average of the highs right there. So we would have had a gain right there. Now, you could just clearly see too that there's going to be periods where you get whipsawed, and that brings up just a great point. But here's just a prime example. I think I already pointed this out. And we want to make sure that we are, again, using the previous day's moving average of simple 5-day simple moving average of the high. So we would have gone long right there when it exceeded, just barely touched and then exceeded the previous day's 5-day moving average of the highs. And that's a breakout to the upside. And then we would have been in with this trailing stop of the 5-day simple moving average of the lows coming up to where it came down barely right there, touched the previous day's 5-day moving average of the lows, and then we would have been out. And that would have been a little gain there. And do you see what happened the next day? Boom. Right at the open, we would have been long right there then. See that? And we're going long. Now, this can really produce a lot of whipsaws. You can go through here, and even on this chart, you'll see several whipsaws. Intraday entries, yes, Brian, these would be intraday entries. Yes. I mean, just look at the recent activity here that we have, where you had a break. Just what happened yesterday. Okay. Now we've been, we would have been out the previous day. We would have been long at this open here, out here for a loss. Then yesterday we would have been in right here, and then out today, all in one day. Boom, out. So 2 straight whiplashes there. Okay, and clearly, you know, when you're trading breakouts with the trend and you start doing systems testing on that kind of an approach, your percentage of wins is going to be under 50 typically. And then, you know, as you tweak the system, and then typically then you're going to have somewhere, you know, 40% wins, but because you're trading with the trend and you're letting those letting the trend go, and your gains, you know, are theoretically unlimited on the upside, right? So you're going to have a high average win to average loss because you're cutting your losses short. And that's the nature of trading breakouts with the trend in terms of just generally in trading systems in general. Now, but that brings me to the idea, and this whole thing got me thinking, you know, I remember this other book, and I have this book, and it was in the same room I was clearing out the other day. Larry Williams wrote this book, oh gosh, late 90s, I'd say. Long-term Secrets to Short-Term Trading. And in that book, he has a very similar system, but he's trading the opposite. He's going the opposite way. So let's just go and look at this. Now, he doesn't use a 50-day exponential moving average, by the way. He uses swing points to define trend. So I'm just going to keep the rules the same on the terms of the 50, but you should know he uses, basically look 1, 2, 3 highs and lows to determine his trend. Whether trend, you know, basically, where's a good example here? Well, I think we, okay, so for, you know, in Larry Williams's world, you had a price going up, down, up, and then when it came down below this low, well, that means we're in a bearish trend right there. And then he would be going the opposite. And then when price came up above this isolated high, that's when we're all of a sudden bullish. And then when price exceeded the previous isolated low, now we're bearish. And then we're bullish right there. And we've been bullish then theoretically ever since then. Okay, in the world of swing trading, isolated highs and lows like that. And that's what his approach is in that book. Now, what what we're going to do, though, for the purpose of building our system here is, I'm most interested in Larry Williams's approach to fading the trend. So here's what, the entries, basically trading the pullbacks. So if we're above the 50, we're going to go long when price touches the prior 5-day moving average of the lows. So here we are above the 50, we're going up. When price comes down and hits this low right here, the previous day's average of lows, boom, that's when you go long. And then what he was doing was getting out when price was going up and hitting the 5-day moving average of the highs. And so he claimed in his book to have made at one point, and he's trading intraday bars, hourly bars, 30-day bars, and this is what he does on short-term trading. That's from his book, his day trading approach, is he was basically then trading, from the long perspective, long, but he would wait and go long when price touched the average of the lows and get out when it hit the average of the highs. And so in this example, okay, where then he would get out, and then he would get in right here, going long, and get out right here. He'd go long right here, and get out right here. He'd go long previous days. He'd go long right here, get out right here, win. He'd be in today right there, and he's waiting for it to go up and hit the 5-day average of the highs. He may have used 3-day, I'm just thinking maybe 3-day average, but I think you get the picture. Here I just showed you four straight winners. And he claimed in his book to have, had at one point dozens and dozens of straight winners without a single loss at one point in his day trading career. Now, here's the deal, though. In his book, I don't remember, and I scoured the book looking for his stop loss. He did not define when he would get out. In other words, so when you go long right here and then price continues down, at what point do you get out with a loss? You can certainly come up with your own rules. In his book, he didn't really say. Maybe I'm wrong there. Maybe if one of you know what he said or want to get the book and check it out, it's available online. I'm sure it's at half.com or eBay or whatever, or you can get it at Amazon. But anyway, he took the other approach, and this is more in the spirit, I think, of trading credit spreads. In other words, when we have a trend going to the upside, and then we have a pullback, let's say, we're going to then sell put options, put contracts that are yet further out of the money. So after a pullback, we're going to challenge the market to go against the trend and keep pulling back a certain amount before it hits our out of the money short strike. That's kind of in the spirit of high probability credit spreads trading with the trend. So I'm going to go with this approach, all right, and come up with a set of rules and just see kind of where that takes us, all right? So let's trading pullback. Oh, and here's just the other way, trading pullbacks with the trend. It's just opposite here. Let me get rid of this. This is simple moving averages. So just to reiterate, bearish side, we're going to trade when we're from the bearish side when we're under the 50-day. We go short when price touches the 5-day simple moving average of the highs. So let's just pick one here. Hit the low, and that comes up and hits. Okay, well, here it hit the 5-day average of the highs, and then we're out here. Then we're short here, getting out here. And then, and then we didn't catch any of this, and then we're going to go short here, and we get burned then. Now we're getting a loss. It keeps going up. It never did hit the moving average of the lows, and all the way up it goes. So here, where is the stop loss? SL, question mark. Okay, so you have to come up with a good rule for that because I don't think he helped us. That's trading from the bearish side. And here I just showed you again previous one, you'd get short here, and then we would have gotten out here, and then short here at the open because we're above the moving average, and then we're out here. Okay, and then we would not have been in again until here. We would have been short there. Okay, so now let's come up with our credit spread rules. Just taking this approach, this is just a short-term credit spread approach. We have our technical analysis system that we're moving with, and of course we can tweak it, go to 4-day average, 3-day average, whatever, but I think you get the picture. Let's just stick it with 50 and 5. Here are the parameters that we have to come up with, and then back test and just get a feel for different parameters that we could use. So I'm just throwing out these rules for your curious to your opinion, and then I'm going to back test it a little bit more and see how well this goes. And especially we want to see how the losses play in. We need to determine how far out in time we're going to go, days to expiration. We need to determine where our short strike will be in the long strike and determine the spread. We need to determine our exit strategy for profit and for loss. And with that, with those 5 items filled in, we're going to have the means to then go and start using backtester or backtrader and go into town. Okay, short strike and long strike. So here's what we're going to do. Just to kick it off, we're going to go out of the money, and we're going to have to round this, but we're going to go out of the money by the 5-day average distance between a high and the low, between the highs and lows. So in the SPX, that could be anywhere from, say, 8 to 15, just depending on the season we're in. In a bear market, the daily ranges are much greater than in a bull market, and so keep that in mind. But whatever that average distance is at that moment, we're going to basically go out of the money and then round up. So we go a little farther out. I mean, if it's at 8, we're going to round to 10. Okay? If it's at 12, we'll round to 15, something like that. And then we're going to do a 5-point spread, just starting out here, just out of the money by an additional 5 points. Then, where do we go then for our days to expiration? How far out in time are we going to go? Well, I'm throwing this out there because this is, I think, makes a lot of sense. We're going to go as few days out as possible, so long as the modeled expiration profit to hypothetical loss ratio is 2 to 1. All right, and I'll show you an example of this in just a second. So, okay, and basically, when you go to the very front weekly set, or it could be even quarterly coming due this week, you go ahead and go to the nearest expiration and see what it looks like, model it, and if its modeling is less than 2 to 1, well, then you go to the next expiration out, and that'll improve it. And if that one doesn't work, you go to the next expiration out. So you begin with the nearest and start marching it on outward. Now then, how are we going to exit this thing? Well, let's talk about exiting for a loss first. Real simple. We're going to exit when the price strikes the short strike. When the index or the stock or the ETF, whatever you're trading this approach with, when it hits the short strike, you're out. Real simple. Now, exiting for a profit. I just think this is probably a good way to go because of the nature of the way this, even of the example I just showed you, where we can, your target, the Larry Williams target, where it just goes from one moving average up to the other one, can happen in a day or two. Well, that's, now we have some time on our side to keep advancing. So here's the idea. Okay, when price does hit that opposite side, simple moving average of the high or the low, depending on which direction you're going, when it does move in the direction of the long-term trend, go ahead and scale out half your position. So you got to trade at least 2 contracts. Scale out half and let the other half ride, but move your exit to the break-even point to make sure you don't lose money, to try and not lose money on what remains. And then just let that, whatever remains, let the other half of your position go to expiration and let it expire. Real simple approach. Let's take a look at an example, and then I'd be curious as to your comments or tweaks. So here's an example where price comes down, and on that day back this year, earlier in late May, late May 31st maybe, price came down and just tagged the previous day's moving average of lows. So here we are in an uptrend. Price comes down, it retraces, goes and hits that 5-day average of the lows, and at that point, boom, we're going to go long by doing a bull put spread. We take a look at this distance between the high and the low, which is, what, 8-9 points, something like that. We're then going to go further out of the money from here and come down and sell a short strike down here somewhere, maybe the 23.95. And we're challenging the market to then continue down further and hit that 23.95. Okay, if it does, we lose money. If it doesn't, or if it at least takes a while, we're going to make money then. In this case, the market then bounced right straight back up. So here we go, and you can see that it works out to where we're going to the 23.95, 23.90 bull put spread. When I modeled it in this initial, the June 2nd expiration, which at the time was only 3 days away, the ratio just didn't work out. But when I went out further, we now have a modeled ratio which is good. So what I'm talking about here is we're modeling the ratio of the yield obtained by letting this thing expire worthless. That's 32% yield. Okay, we want that to be twice as much or better than the modeled loss if price came down and hit our short strike right here. See that? So we would make more than twice. It's right there pretty well. You know, we would lose half as much here if price went down right away and hit our short strike. We would lose half what it is this position is modeling at expiration. Okay, now we know this thing worked out. And so within a day, this thing then raced upward, and we would have gotten out for a nice little nifty profit. In this case, it worked out. Let me just show you where it went. Okay, it went upward, and let me see here. We can see we got in right here at the very open the next day. It opened above that moving average from the previous day right there. And so because we got in right here, price went up and then gapped up at the open at that moving average. And so what did we get out of that then? Okay, we walked away with, so we're making, you know, the whole position is making 122 of 240, about half. We're making half the profit there. So really, looks like IV bled out, and this line went up from the bleeding out of the IV, even more than what was modeled. So we're going to scale out, take a profit of $61, and let the rest of this ride. Okay, and I don't have the picture there. We're going to let the rest of it ride. We're going to gather our 61 bucks, let the rest of it ride, and so we have our 61 bucks. And, you know, inclusive of everything, when it then expires worthless, we made $183 on an initial break T margin of 755 for a total yield of 24.2. Okay, not too bad. Now, that 24.2, how does that fare in terms of the initial modeling? Let's go here. All right, so we made 24%, kind of like that's clockwork here, and 24% relative to what it is we were trying to make here. So here, had we lost money, we would have lost probably 16, 17%, and we made 24. Okay, that's pretty good. Now, mind you, this approach, as Larry Williams said, you make money more often than you lose. At least you're going to scale out more often than you're going to get burned immediately when it goes the other way, because the markets chop around a bit. And so I think there's an edge here. We'll have to see from back testing and studying different markets to apply this approach. But anyway, I submit this just for your consideration, and also my further research will take us down the road a little farther. Okay? Any questions, comments? Thomas, Brian, Ben, Jim, thanks for joining us today. All right. I would consider a second profit target, 80 to 95% of the credit. So, Brian, I mean, you would trade 3 units? 3 units, scale out 1, let the other 2 ride, scale out a second unit at 85, 90% of it all, and then let the rest expire worthless, so you would go with 3 units? No, I would just not hold the expiration. Oh, I see. Okay. Yeah, that makes sense. You would just exit at 85 to 90. Yeah, because you could have that with a week to go yet, right? I mean, if the market races upward, you could get that 85, 90 right away. That makes sense. Perfect. That makes a lot of sense. Thanks for that. Okay, anyone else? Awesome. Thanks, everyone, for joining us. We'll be back next week. Perhaps I'll ratchet this up and get some good back testing work in. Take care. Have a great rest of the day. Bye-bye.